Hello everybody, I'm Shrinidhi and welcome to this channel. We are now in the process of learning finance, specifically accounting. So in that process, we have so far seen the basics of accounting, on why accounting is first of all required, and what is the need to maintain such books of accounts, or why is this big process of accountancy itself required. Of course, I have also posted on other videos on AS9 and accounting standard on property, plant, and equipment based on demand. So, upon request, I have posted these accounting standards as well. I have also given a brief introduction on why accounting standards are required. So, if in case you're new to this channel, then you could refer to the earlier videos on the same. So, in today's session, we are going to understand some more basic terms in accounting before we move further into nuances of the process of accounting, like the recording, classification, summary, and reporting. Before moving into the detailed areas or phases of accounting, there are some basic terms which it is which are necessary to understand first before we move further. So in the earlier introductory video, we have learned on why we need to prepare accounting, and in that quest we got to know that it is the users of the financial statements for whom we are preparing these elaborate process of maintaining books of accounts and preparing the trial balance sheet, and the profit and loss account, or the detailed financial statement. So it is basically the users who are going to use this information for various decision making, depending on what kind of user they are, whether it is the management or the consumers or the government or any other investor. So, depending on who they are, they would be looking out to the financial information, in the financial information to know the performance, or to take a decision pertaining to their need. So, for this, the financial statements are being prepared, and so they are the end users. So, when they are the end users, they later understood that there is a need to maintain a proper standard or way of presenting the information, so that users, irrespective of who they are, they could look through the financial statements and compare it across the sectors, across the entities, across the businesses. Having understood this, now let's move on to certain characteristics which are essential to have the accounts as the source of information for the users. So these characteristics are: one is reliability. The information has to be such that the users can depend on it and make decision. So this is the key feature of the financial statement. It is very important that the information, or the financial information which is being presented in the financial statement, is very, very important. The next is relevance. Useful accounting information, if they are not relevant to users, it won't serve the purpose. So we have to ensure that whatever information is being presented in the financial statement are relevant for the users. So we have various types of reports also catering to the varied users. Next is the understandability. So the main motto of preparing the accounts is that it should reach the users in the right form in which the information is intended to be communicated. So whatever is being intended to be communicated is to be put across the users in an understandable form, in the sense they should be able to understand it without any iota of doubt. So that is the reason why we give lot of disclosures, we give lot of notes to accounts and stuffs, which are the annexures to the financial statements. So that is about understandability. Moving on to next is compatibility. Compatibility or comparability, or rather. So it is it should be prepared in a comparable basis so that the financial performance of a particular entity can be compared with that of another entity which is belonging to the same sector. For example, say if it is an FMCG nature of company, then two industries or two entities with under this FMCG group could be compared only if they are prepared in such a way that these two performance could be compared or related. And one more way of comparability is comparing across the previous years. Comparing with the prior year performance is another way of comparing the performance. Next is uniformity. In order to compare across the entities, it is essential to have some uniformity while preparing the financial statements. And this is the reason why we have standards or code of conduct, like how we need to be disciplined, like how we have the code of conduct. We have these standards or basic codes or norms based on which the financial statements have to be prepared. So why? Because it should have some uniformity so that the finally it is the end users who are going to benefit, who are uh, for whom these financial statements are being prepared. So finally it is the end users for whom these financial statements are being prepared. So for that purpose, it is essential that the financial statement should have all these basic characteristics. Moving on to next. So these are the basic accounting principles which we need to understand. So we have the apart from the main three accounting principle, that is going concern, consistency, and accrual. So going concern, consistency, and accrual, these three have already been covered in a shorts video. In the description box, I have provided the link. So details on these three basic accounting principles could be referred there. Apart from these three, there are further five more, means there are many more. The top important ones I have listed here. So one is periodicity. It is very essential to understand the performance of an entity or business in order to take the right decision with respect to its growth. So, for that, there is a need to assess its performance on a periodic basis. As we have learned the first basic accounting principle, that is going concern, we have already learned about it. We have to take into account that the business continues for an infinite period in future. Assessing would become difficult unless we split the period into definite recurring intervals, right? So for every quarter or say half yearly or yearly, that is annually, depending on the need of the entity, this financial statements need to be prepared. So, for example, while auditing, we do an annual performance audit, which would be an annual audit, or there could also be an interim audit in which every 6 months period are being audited, so that at the end of the year it wouldn't be a Herculean task to audit the entire 1 year's transactions or the performance. Audit will be conducted at an interim period or a quarterly period. So in similar basis, the performance is to be audited. Prior to that, the financial statements need to be prepared, right? So this concept of periodicity, by which the entity is required to prepare separate accounts for each of the period, is necessary. This in turn facilitates it to make a comparison of its own performance and improve the gaps if in case necessary. So this periodicity helps in comparability, and also it helps in understanding better on its performance. So that is the one more advantage of having preparing the financial statements on a periodical basis. Next is cost concept. According to this concept, the value of asset is ascertained based on its purchase price or at its historical value. So, at its historical cost. Valuing the asset based on any other methodology involves some sort of uncertainty or assumptions involved, which tend to change based on facts and circumstances of the case. So, if the historical cost is the base, so whatever we book in the financial statements on the books of accounts, we book it at its historical cost. Moving on to next, matching concept. As per this concept, all the expenses are to be matched against the revenue which are generated in a particular year so that we can ascertain at the correct net profit. Many other concepts like capital and revenue expenditure, concepts on depreciation are also based on this matching principle. Moving on to next, the dual concept. This is the base for double entry system of bookkeeping, which says that every debit should have a credit. The logic behind this is any transaction or event impacts two different entities. There is always a giver and there is always a receiver. So, similarly, if there is a gain, then there will be a loss. So, like how we say every coin has two sides, right? Like that, for every transaction, there are two sides of every transaction, we can say. And this is applicable for everything. Whatever we see, there are two things. Like if there is a, like how we say, if there is a cause, there is an effect, right? Science, we say if every action has equal and opposite reaction, right? Similarly, so everything has two sides. So this is the base of this dual concept. Though single entry system of bookkeeping is being followed in very primitive stage of business, single entry system of bookkeeping is followed. But still, we can say that the way of bookkeeping is only single entry. But we cannot deny that there are two entities or two people involved in every transaction, right? So also, when an individual gives, he also gets something in other form. Even if we see in a barter system, there are two people involved. They may not pay money, but they will give some good one and get good too in return. So there is no money concept, but still, yeah, every transaction had two people involved. There was a dual concept. So uh, this concept is another principle, main principle in accounting. And finally, materiality. As per this principle, only those which are significant are to be disclosed or to be considered, because if the cost of accounting for insignificant transaction becomes more than the amount which is being accounted itself, it would mean a sheer waste of time and energy, right? So only material informations need to be disclosed. What I mean to say here, materiality is all the all the financial transactions are to be recorded. There is no doubt in, even like material concepts are only to be recorded. Small values need not be. It is not about. It is not materiality is not applicable with respect to recording, classifying, or with respect to the accounting. What I mean to say is while reporting material changes or material financial information which would significantly impact the decision making of the users. Only such transactions are to be reported separately. Financial statement, when I say, includes the notes to accounts as well. For example, if there is a possibility of impairment, so we know that the we are recording at cost. So we are recording at historical cost. So in the books, for example, a particular asset would get recorded at the historical cost only. But if there is a scenario happens that the price of which is has reduced a lot, or if there is a situation or there is a risk of any impairment, we can't directly impair it in a particular year. This is a major information which the users need to be communicated. So we need to report on this first, and then later, depending on how the value goes in the subsequent years, we need to impair. So such risks need to be reported. So this materiality does when I say materiality, it is not with respect to materiality of the value that the recording should happen or not happen. It is about the reporting of the financial information that would significantly impact the user's decision making. I hope this is clear. So I have just picked five major accounting principles which are necessary to be understood before we move further. There are various other small principles as well. As and when we we come to know about it in the subsequent sessions. Maybe I will make a mention of it and explain it further. Next, these are some major uh, terms which we use in accounting. Like there are various other terms like what is an entity or business, transaction, assets, liabilities, income, expense, profit, loss, gain, losses, sales. So there are very many common terms which generally people would know. But here I have chosen only those terms which are specific to this particular accounting, where these terms we use more, and these are a bit specific to finance, or in if we have to move further on the other steps on recording, classifying, those steps on accounting, then we will be using these terms more common. Just the major heads on the financial statements, and I have put it across. Of course, if in case you would like to know any specific terms or if you have any doubts, then you could for sure leave them in the comment section below. And now moving on to the first term which I have taken is capital. Funds invested by those who own the business is capital. So whoever is the owners, they contribute to the entity, their funds, owners' funds is nothing but capital. When we learn on the further steps on accounting, we will be learning with respect to sole proprietorship. Then we will move on to partnership and corporate entity. So capital is a term which is being used in any sole proprietorship. And when we move to corporate, we use the term share capital. Once again, it is a capital. Share capital because it is being contributed by multiple people, multiple investors. So this is the term which you use. Once again, it is the capital of the entity. Next is stock. In case of manufacturing unit, there are raw materials, inventory of finished goods, and some which are in the process to be finished. So all these form part of stock. So stock need not be only raw materials. It could be raw material, it could be WIP, work in progress, and it would also include stock of finished goods. So all three would come under the category of stocks. Moving on to next, debtors. Those who owe money to the entity. That is anybody who has received the service or bought good from the company, but he is yet to pay for it, then this X is a debtor. And similarly, creditors, those to whom the entity owes money are the creditors. For example, say the entity had bought or received a particular service from someone Y and he is not yet to pay. And in this case, this Y is a creditor. I hope this is clear. Finally, in common terms, we call this as fixed asset, right? So in the new accounting standards, we call it as property, plant, and equipment. So it is nothing but tangible asset. Tangible asset, intangible asset could be anything like goodwill, copyright, patent, or trademark. These are intangible assets. So assets which are meant to be used in running of the business, the benefits of such assets extend for more than one financial year. So these are tangible or intangible assets. For both of these assets, the uh, benefits are reaped for more than one financial year. This is about tangible assets. The benefits they are invested in 1 year, but the benefits are for more than one financial year. Intangible assets are these examples which I have given. It could be goodwill, copyright, patent, trademark, and all. So these are the basic introduction on few terms, so few principles on accounting, and we have seen the basic characteristics of financial statement. If you, in case you have any doubts or any particular area specific which you would like to know more, then you could leave them in the comment section. Also, leave your feedback so that I could work on presentation and come back with further more details and information on accounting. Do like, share, and subscribe to this channel if in case you are more interested to learn more on finance here. Thank you.